My name is Jeremy Fielder, retail investor, macro strategist, and I wanted to share my view that October was the low for markets, S&P, NASDAQ, crypto. And although we have these recession and inflationary headwinds, I think the market just moves sideways, but it can grind higher if the following tailwinds come into play. Now, we do know the biggest risk to the markets are going to be complete collapse in growth or inflation being stickier than expected or resurging. But so far we see, for example, S&P, breaking that bear market trend and grinding above the 50 and 200 daily moving averages and the weekly moving averages. And so, you want to ask the question, what could be reason that the market is grinding higher regardless of all these headwinds? Now, first, I think it starts with inflation. On every year over year metric, inflation is falling. Right now, core is a little stickier, but shelter and real-time rents, when we look at Redfin or we look at Zillow data, we see that those are collapsing too. Even the Case-Shiller home price index are falling. So I think the Fed's data is just lagging, and that's going to come into play, and that's not going to be an issue. And so that really leads us to the hiking cycle, right? And I think the Fed just really wants to see inflation, CPI, PPI, PCE below Fed funds so that they can pause. And the deposit flight, the credit crunch, all those things, right, are starting to do the Fed's work for it. We see things breaking in the economy. We're starting to see commercial real estate break to some degree. And I think that's pretty much doing the hiking for the Fed, and they're pretty close to the edge where it's like, okay, we can pause and let things happen. I think the market is looking forward to that. Next, I think one of the other big catalysts are going to be liquidity. Global liquidity is picking up. We see China into money growth, loan growth, the credit impulse cycle starting to turn back up. And global liquidity is one of those catalysts that can trickle into capital markets. Japan is also stimulating at the same time. So, global liquidity picking up M2, I think that's a catalyst. Other central banks are starting to pause, right? The cycle is starting to change. And when you put that together with negative positioning, and positioning is that other catalyst, right? Fund manager surveys show very extreme negative positioning. Everybody's hoping or everybody's betting on an S&P below 3,500 by end of year. So I think that negative positioning, that negative positioning has always led to the bottom of the cycle, the bottom of the investment cycle. And we're starting to see that. But it's really going to take us, it's really going to take earnings to really take the market, S&P anyways, above that 4,200 level. And so I think what we should remember here is that on average, stocks bottom 6 to 9 months before earnings bottom. Over the last 6 out of 7 bear markets, we saw that. We saw stocks bottom 6 to 9 months beforehand. Sometimes it was 4, 6, sometimes it was 12. And my point here is that if October was the low, it wouldn't be abnormal that earnings bottom in April and even up to July, which would be the ninth month. And it wouldn't be abnormal that the S&P is still grinding higher, right? But what we really need to see the S&P, I think, break over that 4,200 level is going to be better than feared earnings. And I think, when we look at margins, that's an important part of earnings. We've seen a lot of aggressive cost cutting, and we don't know what that's going to look like. But I think that lends to better than expected earnings because those margins are, better than feared from the aggressive cost cutting. We see producer prices also coming down, PPIs coming down, global supply chain pressures indexes are coming down. So that lends to little better margins. And we know a falling or weakening dollar is going to help multinationals, right? Multinationals are going to boost from that. Plus, the multinationals are going to get a boost from international demand from China, from Japan, from those other countries who are starting to now stimulate. And I think when we put all those variables together, and we think of the market just wants to see growth slow down. As growth slows, we're going to get lower yields, right? And I think the last part of that is lower yields equals lower rates. But the last part of that is if we get lower yields, if growth slows down, oil comes down, that takes the inflation stickiness off the table, and the dollar starts to fall. And I think if we get the dollar break under 100, then, that's going to be a real risk on catalyst. We do see triple B spreads also falling, showing that there's still a risk appetite in the market for equities. And we also look at volatility, bond volatility. I think it peaked, it's coming down now, and NASDAQ volatility is coming down, S&P volatility is coming down. So looking at all those factors and considering the technicals, I think there's a real reason for the market to, trade sideways. The market, the lows are in, but definitely a break above that 4,200 level. That's my thesis.